In this video, I want to talk about Decker Outdoor Corporation. Now, I just barely put on an iron butterfly, and I want to take you over and I want to show you how I did it and what my thought process was for putting on this iron butterfly. And I'm going to take you over to the demo account because I've already done it here in the real account, and I want to put it on for you in the demo account so you can see how we did that and what the thought process was. So hold on one second, we'll get over to the demo account. Okay, here we are in the demo account, and you can see we've got Decker Outdoor pulled up. And if we come out here to the charts and I just go to the daily chart, you can see on the daily chart here in the demo account that we've got the market coming in through this nice little sideways channel. It had a nice big drop here back in July, and then the market's come down and it's just kind of going sideways. We had a little gap open right up in here, and usually this is considered a continuation formation. And so looking at that, that would be another, a rally to the upside. But right now, we've got earnings coming up on Decker Outdoors, and you can see that the volatility is a little bit high on this one. And so there's an opportunity for us. And the reason is because if we look at the calendar over here on tip ranks, you can see that on tip ranks, we have an earnings coming up on October 24th. All right, so that's important, October 24th. Keep that date in the back of your head. We're going to come over here and I want to look at hedge funds. Notice that the hedge funds are very negative on this market. We're not going to have these guys dumping a whole bunch of money in there anytime soon. The news, pretty neutral. Nothing really bullish or bearish in one regard, one way or the other. There's a little bit of bullish news, not a whole lot. 8 days ago was the last time we had anything on there. And if we come in here and we look at the insiders, nothing really exciting going on there. Bloggers, we don't really care about those guys. And then investors, it's pretty neutral in there as well. And then, of course, we come to the analysts, and they're all pretty neutral. Low of 148, a high of 205. And then we come to the smart score, and it's down here around 2. All right, hedge funds have been decreasing. So what this is telling me is that there's nothing really exciting about this market right now. All right, and the most important thing is that it's waiting for earnings to come out. And the earnings are not going to come out, as we said, if we come back here, October 24th. So if we look at the calendar, October 24th, that's not for another week. So we've got a little bit of an opportunity in here. So let's come back over, bring ourselves back over to track and trade. You'll notice, though, that the implied volatility is still relatively high. So that's good for us. What we want to do is we want to come in and we want to sell some of that, those expensive options. And we're going to do it just on a very short-term time frame. We're going to go on 2 days. 2 days, okay? So we're going to come in here, and we're going to come down to a 15-minute chart, make this easy to see. And we'll squeeze that down just a little bit so we can get the options on there. And you'll notice on the 15-day chart that the market, the implied volatility is not, it's not too high. It's bounced a little bit, but it's not too high. And you'll notice that the DMI is coming down. It's drifting down, which is good, which is what we want to see. We don't want to see this thing all active and jumping all over the place, and because what we want to see is this thing just quietly decay into expiration, all right? Just kind of quietly go away into expiration. That's the name of the game here when we're selling premium. But we do want to sell some expensive premium. Now, we're not selling too expensive. If we come down here and look at the theoretical value, you can see that it's $166. We're going to sell it for $160. It's worth $233, and we're going to sell it for $220. A little bit lower than what the theoretical value is, but that's because the market's going sideways and it's kind of quiet. But that's okay. That's what we want. If you go a little bit further out of the money, look at just one step out of the money, $57, $27. Those are our wings. That's all we're going to have to pay for those things. Now there's a couple of ways we can put that on here. We can just come in and drop down to the template, hit Iron Condor, boom, that thing's on the screen. We can just drop this in, make it an Iron Condor, bring those legs in, bring that up to one step out, boom, boom. There you go. There you got a nice little iron butterfly. You can see down here, total premium credits $292. Our margin's $500, and it's reducing our buying power by $215. That is the simplest and easiest way to do this. We can just go ahead, hit place order, and we are in the market with a nice little beautiful butterfly waiting for this thing to expire and collect that premium. We just don't want it to rocket out of there somewhere and go crazy on us, right? And if it does, we got our insurance policies in there, which we're buying them below the value of the market, right? $27, $31. And so if they did, they would increase in value, and they would start helping us pay off the premium of the options that we sold. So that's a nice little butterfly in there. I like that. And we could just go ahead and hit place order and take advantage of that position right now. But I'm going to show you something else. I want to show you a little bit, just give you a little bit of a lesson in here on these iron butterflies and iron condors, and show you another little something that you might want to be aware of. So let's go ahead and cancel this. And if we come down here, I'm just going to bring this window up a little bit. And I want to show you the probabilities. This is what I call the delta cone of probabilities, all right? And this is the probabilities of being in the money. So if we look at this thing, we can come out and we can put on an iron condor. Now, track and trade gives you the two ways, actually gives you three different ways to put on the same strategy, depending on what you want to do and how you feel most comfortable. And so the first way is just to use the, use the quick drop method, which you just drop it on the screen like that and put them where you want them, exactly where you want them. Or we can come in here and we can drag them in here one at a time. And this is really cool because we can come in here and we can just go say, all right, I want to, this is an iron butterfly. I'm going to come in here and I'm going to sell a call. Actually, let's buy our outer wing. We'll just go down the list. So we're going to buy our call and we can put that one out here. And then we're going to sell a call and we're going to put that one out here. And then we're going to sell a put. We can drag that one on the screen to where we want it. And then we're going to buy a put and we're going to drag that one on the screen. And you'll notice that it builds the iron condor for us as we go. Now that's an iron condor. And you can see the line is between them indicating that those are all one order. We'd send those all into the exchange simultaneously. They go to the special complex orders desk and those fill all at the same time. That's the nice thing about having track and trade do this for you, send these in, because you don't want to have one leg filled while the other one is still sitting open. And so by sending them into the complex order desk this way, they'll all be filled simultaneously as one single individual. So at this point, all we have to do is just come in and we can drag these legs to wherever we want. And in this case, we want the butterfly, so we drag those on top of themselves. And then, of course, the further out the wings are, the less insurance we have, right? But the insurance policy, we can just drag those to our new location as well. And you can see down here, the calculator tells us total premium credit is $295. If we drag those wings out one more leg, of course, we're going to make more money, theoretically, $340, but we're also getting less insurance. So the further those legs are, the less insurance you're buying. And the more money you're going to make theoretically, as long as the market stays inside of your box. But if the market does jump and run, then your insurance policies are a little bit far away. So you can bring those in and price those out at the level, whatever level you feel most comfortable with on how much you think this market's going to run. The closer you put those, the higher, the better insurance you have against losses, but the less profit you're going to have as well, because your total premium is going to go down. Now that's the nice way of being able to drag and drop these orders on here and build your strategy, as opposed to using the template. Of course, the template, you can create your own templates and build them however you want in here. So we can come in here and we're going to add a template in here, and this is the window where you come in and build whatever strategy you want for your defaults. So now I'm going to show you one more way, which is really cool as well. So let's cancel that one. We can come down here to the options chains. And in the options chains, this is what's really nice about track and trades. We can take a look at these options chains and we can say, okay, well, what I want to do is I want to sell these two inside ones. So you can just right click on it, say I want to sell. And you'll notice it drops it on the screen, and right click on this one and hit sell, drops it on the screen, and you can see that we now have a straddle, right? So we've just stuck a straddle on there, and you can see the profit potential on the straddle is $375. But a straddle doesn't have any insurance policies. What if this thing takes off and runs to the moon? Well, you're kind of in trouble because you have no insurance. So let's go buy some insurance. And the way we do that is we just come in here and we can right click on these insurance policies out here. Now this is the call insurance policy, so we can buy one of those, and then this one down here is the put insurance policy, and we can buy one of those. So now we have our insurance legs in there, and you can see that you can do it that way as well. So I was mentioning earlier the probability of being in the money. Oftentimes you want to look at the probability of being in the money and looking at this delta cone of probability. And the reason you want to do that is because you want to kind of think to yourself, where do you think this market's going to go? And you say, well, technically speaking, I think it's going to stay in this narrow sideways channel, right? But if it broke out, the computer actually mathematically calculates the probabilities of being in the money. So let's come out here to only out of the money options, and we can see our cone of probability. So if we come out here, you can see that this thing only has a 2% probability of being in the money. The 175 call only has a 2% chance of being in the money at expiration. That's pretty darn good. That means that we have basically a 98% chance or 97% chance of having this thing remain inside of our narrow sideways channel, and that's what we really want. And there's where you're putting your options out there for your insurance policies. And so as you get closer to the market, now this isn't a very deep options chain. For one reason is because it's going to only expire in 2 days, but the options decay very quickly because the market's just not moving. And so that's where you put those insurance policies. We're only one click out of the money, as you can see, and that puts us at, if we come back here to both, you can see one click out of the money is only a 160, and you can see that up here, 160 call. And you can see that the 160 call is only 27.50. And of course, that's the midpoint. What we're seeing up here is the actual call side. So that's $40 is what we're going to pay for that thing. And we're going to pay $75 on the low side. So that's just a beautiful way of being able to come down. Look at that delta cone of probability. See what the probabilities are of those things being in the money at expiration, and giving us confidence in our position. So here we see that we're going to collect total premium of $297, and we're just going to come in here. We're going to go at the market, and that drops us down to $205. So you can see that the midpoint, if we go to credit, is $297. They're asking $390, and then the credit side, or the bid side, is $205. So if we go down to the bid side and drop that down all the way down to the market, $205, that takes about $90 off of our profit potential because of the spread in here. Now the spread's pretty wide because we're coming into 2 days until market expiration. Okay, and so what we're going to do is we're going to take that 205 credit, and we're going to put have the profit potential of $205 as long as that thing stays quiet and sideways going into expiration. So we just go ahead and we place our order, and you can see our order is filled. The colors drop into our box. They're no longer black outlines, and we're filled. And you can see that if we come over here to positions, just for the chart, there we go. There's our positions in the market. All right, and that's just a quick example of what I did this morning on Decker Outdoors.